Financial markets have a clever way of deceiving traders, often hiding their true, volatile structure just beneath the calm surface. This is the NASDAQ index. Looking at the price action on the right side of the chart, we see a relentless V-shaped recovery following the late August capitulation. The headline price action looks bullish, but measuring internal market breadth against the upcoming macro calendar reveals that these surface-level gains lack a broad foundation. Our objective today is to synthesize the closing data from August 27th to build a strict defensive trading plan for the upcoming Friday session. As always, this analysis is for educational purposes only and is not financial advice. Trading involves significant risk. We are evaluating this market strictly through the lens of institutional risk management. That means prioritizing capital preservation over momentum chasing. Surviving the August 28th session requires ignoring the green headline numbers and dissecting the conflicting data underneath. This is the Dow Jones Industrial Average. Notice the sharp drop into the third week of August. Selling pressure peaked on August 21st, with the index finding a floor near 52,800. From that low, we get a nearly vertical rally on the 1-hour timeframe, pushing the index straight up to 53,567. Let's transition to the tech-heavy NASDAQ to check if it mirrors that aggressive bounce. The structure is identical. We see the exact same recovery, climbing from 28,900 to 29,641. But here is the problem. Both of these indices are now slamming directly into the origin point of their previous breakdowns. This creates heavy overhead resistance. Traders who bought near these peaks before the drop are currently trapped underwater. As price returns to their entry point, they are highly motivated to sell to break even. The velocity of this bounce is impressive, but the structural long trade is exhausted. Buyers stepping in at these levels are completely exposed at resistance. To understand what is actually powering this recovery, we have to look past the price charts and examine the market internals. This is the S&P 500 heat map, visualizing performance across every sector. It shows a massive disparity in how capital is moving. Notice the concentration of capital flowing into the top left corner, specifically into mega-cap tech names like Microsoft and Broadcom. The standout is NVIDIA, closing up nearly 9% in a single session and heavily distorting the broader index metrics. The major U.S. indices are cap-weighted. This means companies with the highest market valuations dictate the overall direction of the index. A few massive tech stocks rallying can drag the entire market higher, even if the vast majority of individual stocks are falling. And when we evaluate the rest of the economy, that is exactly what we see. Once you remove technology from the equation, you are left with widespread selling across financials, healthcare, consumer cyclicals, and industrials. The selling in these defensive sectors suggests that while tech indices rise, the broader market lacks the same conviction. This divergence often signals institutional distribution rather than broad accumulation. This creates a highly dangerous scenario. You have extremely narrow market breadth pushing the entire index directly into structural resistance. The current rally relies almost entirely on semiconductor performance, masking the steady decline in the market's foundational sectors. That underlying structural weakness leaves the entire market highly vulnerable to the fundamental catalysts looming on the horizon. This is the economic calendar for Friday, August 28th. Dominating the entire weekend schedule is the Jackson Hole Symposium. This is the premier global event for central bankers, historically known for triggering shifts in monetary policy and market volatility. Moving past the speeches, look at the localized data scheduled to drop exactly at 10 p.m. We have the preliminary benchmark payrolls revision. Note the previous print of negative 911,000. A downward payroll revision of nearly 1 million jobs forces institutions to immediately reprice their internal models for economic stability. Compounding the risk, crucial University of Michigan consumer sentiment and inflation expectations data release at that exact same minute. The combination of central bank rhetoric and deep employment revisions creates a chaotic environment for algorithms, resulting in unpredictable price spikes. Holding aggressive risk exposure into a weekend dominated by central bankers and heavily revised jobs data is an unacceptable gamble for a professional trader.
We are facing a triple threat. Price action is exhausted at resistance, market breadth is dangerously narrow, and a major macroeconomic volatility wall hits on Friday. Given these variables, our strategy must shift from aggressive swing trading to strict capital preservation. Here is the tactical plan for the August 28th session. First, no swing exposure. Closing all directional swing positions and going flat into the weekend is the only mathematically sound defense against unexpected headlines out of Jackson Hole. Second, if you must trade intraday, long exposure must be restricted strictly to the Nasdaq and semiconductor names that are actively demonstrating relative strength. Do not attempt to catch falling knives in the bleeding financial and healthcare sectors. Let the weak charts fall. Third, cash is a position. Holding cash is an active, strategic deployment of your portfolio to protect capital, not a missed opportunity. When technical price levels, market internals, and the economic calendar point in different directions, the professional response is to step aside and wait for alignment.